Hello traders, this is Fawad Razak, market analyst for City Index. Today is the 6th of February. The dollar index has broken above the December high, which means that the path of least resistance remains to the upside following a strong rally, which was driven by a stronger than expected jobs report and ISM PMI, as well as hawkish Fed commentary. So the line in the sand for me is at 102.90, which was the low from Friday. For as long as this level remains in place and we don't break it, the path of least resistance would be to the upside for the dollar index. In terms of support levels to watch, 104.26 was the December high. This is going to be the first line of defense for the bulls. Below that, 103.80 was resistance previously, and we have the 200-day moving average coming in at just above 103.50. So these levels are the key support levels to watch moving forward. And in terms of resistance, 105.65 is the level to watch, which was previously support and the base of the breakdown back in the middle of November. The euro dollar is testing support at 107.23, which is the December low. If it breaks through that, then we could see further technical selling below that level towards 107 and possibly extend all the way to the 78.6% Fibonacci retracement level, which comes in just below the 106 handle. In terms of resistance, 107.80 was the low from Thursday, which is obviously now broken. The 200-day moving average comes in at around 108.40-ish, 108.45 area. So anywhere between 107.80 to 108.45 is where I'm expecting the euro dollar to turn lower from if we see a bounce from the December low. The line in the sand is at 108.97 because that's the high from Friday when we had a strong jobs report. So there's no reason why the euro dollar should revisit the Friday's high at 108.97. But if it somehow does, then at that point you'll have to drop your bearish view on this pair. The dollar CAD has broken its bearish trend line, but it's yet to take out the December high despite the dollar index doing so. So the dollar CAD may have some catching up to do with other dollar pairs. But keep an eye on this blue shaded area where previously it had struggled, although it closed above it on Monday. So the short-term path of least resistance is clearly to the upside following this two-day rally. But the line in the sand for me is at around 133.80, corresponding to this recent low. And if you get a daily close below that level, then at that point I will turn bearish on this currency pair. The dollar yen has pulled back a little bit along with all the other dollar pairs, but the trend is clearly bullish. There's a risk we could see a deeper pullback towards 147.11, the high of Thursday's candle. That level is going to be key support for me, and if we go below that, then at that point we'll have to consider whether this bullish trend is still valid. But for now, it looks bullish, and more gains could be on the way if we climb decisively above last month's high at 148.80. If that happens, then 150 could be the next upside target, which is a psychologically important level. And then thereafter, we have the highs from the previous 2 years coming in at 151.95 area. So those are the next key upside objectives for the dollar yen. Right, let's finish off with looking at some equity indices. The S&P 500 is continuing to print all-time highs. And for that reason, you can't really be bearish on the market, even if valuations are overly stretched and we are trading at extremely overbought levels. But the trend is very strong. So we'll need to see a bearish reversal before turning bearish on the markets. Now, last week we did see a pullback, but it didn't last very long. So this is an indication that the bullish trend is quite strong. The low from that move down was at 48.42. So that level needs to break down from a bearish point of view before we turn negative on equity indices from a tactical perspective. But for as long as the series of higher highs and higher lows remain in place, then there's no technical reason for us to turn bearish on this market. Among the other global equity indices to watch, the China A50 index is an interesting one to keep an eye on because it has shown some bullish characteristics in the last couple of days, ending its prolonged bearish trend by the looks of things. So it has broken this bearish trend line now and created a couple of higher highs above these two highs. So let's see if the Chinese equity markets will kick on from here and catch up with the rest of the world. Now, for more market insights and analysis, make sure to check out the news and analysis section at cityindex.com. I'll see you in the next video. Take care.